Reserve Board and the Treasury should get no consideration from the committee, since the views of these agencies are largely duplicative of the views of J.P. Morgan and other large over-the-counter dealers. Now, under President Obama's proposal to clean up the problem, he adds even more power to the Federal Reserve, which was really the root of the problem. Just continuing with Chris Whalen, the fact that today over-the-counter derivative trading is a leading source of profits and also a risk for large dealer banks should tell Congress that all it needs to know about the areas of markets requiring immediate reform. Many cash and other capital market operations of these banks are marginal in terms of return on investment capital, suggesting that banks beyond a certain size are not only too risky to manage, but they're net destroyers of value for capital in society while pretending to be profitable. By failing to enforce margin limits on CDS leverage while investing new capital in Citigroup, Bank of America, and other large banks via the TARP, the U.S. Fed and the Treasury, as well as global regulators in the EU and Asia, are essentially trying to fill up a bucket with a hole in the bottom. The Fed and the Office of the Comptroller of the Currency are entirely complicit in this contradictory effort to protect the ability of major credit default swap dealers, banks in London, Paris, and New York to continue to do business without any basic prudential limitations. If the U.S. Congress would truly understood the duplicity of the Fed and the OCC when it comes to concealing risks from over-the-counter derivatives, these agencies would be closed down tomorrow. Simply stated, the supernormal returns paid to the dealers in the closed over-the-counter derivatives market are effectively a tax on other market participants, especially investors who trade in open, public exchange and markets. The deliberate inefficiency of the over-the-counter derivatives market is a dedicated tax or subsidy meant to benefit one class of financial institutions. So it goes on, but I think you can see that it's credit default swaps that are traded over the counter, and they're not regulated, and they're huge. So anybody know what a credit default swap is? Okay. So let me make an example. So somebody lends, a bank lends you $99,000, $500,000, $100,000 house. Okay, someone lends you that money. The investor, not being completely stupid, doesn't like the risk of lending you that money with that little capital. And so they want to take off the risk and buy insurance. So if you default, you still get paid. Now, who will they buy the insurance from? Well, somebody with a government guarantee, and it's too big to fail. So they go to Citibank, and for a fee, they purchase a credit default swap, and for that fee, Citi promises to make the investor whole if the mortgage goes bad. Now, Citi looks at the deal, and they don't like it either. So then they go to another party to buy the CDS, and they got a fee for selling the credit default swap. Now they're going to try and find someone who will buy it cheaper. So they go try and find another company that's not well regulated, and that doesn't charge enough for the risk. And now let's just make up a company name, AIG. All right. Now the original investor, okay, the guy that originally lent the money, he finds out that you can't work, have no disability insurance, and you're laid off, and you're probably going to default. So the investor, he feels really bad for you. However, with his inside knowledge of your situation, he and his hedge fund buddies buy 500 more credit default swaps from AIG on your mortgage. Okay, that's what's called a naked credit default swap. Now that's pretty smart. So these CDSs, they're naked credit default swaps. And I know that Christian charity would call on the original investor to help his brother in need, but hey, this is business. Now, if you default on your $100,000 mortgage, there's another 500 investors who are going to collect $100,000 too. So these hedge fund buddies are going to collect a total of $5 million in credit default swaps on your $100,000 mortgage. But only if AIG actually has the money to pay that. Of course, they didn't charge enough for that insurance. But if AIG is too big to fail, or they know people, then the government can step in and bail them out. exactly what happened. You know, I listened to all the commentators, all have said that GM got what, the auto industry got what, 30 billion? With hardly any press, without hardly any note, AIG ended up with what, 160 billion. Okay, what, to protect credit default swaps, which are ones and zeros on computers, compared to the auto industry, which is, you know, real assets and real employees. Okay, now with regular insurance, you know, the states are the regulators. Okay, and the companies have to prove they actually have the money in place before they can sell insurance. And they have to put up real money to make sure that the loss is paid if it occurs. And this is not true with derivatives. They're bought and sold over the counter with very little regulation. And you don't need no stinking money to sell at CVS because you can just buy one from somebody else. And it's one big daisy chain. You know, there are people trying to turn straw into gold. Okay, one question. Who here knows who Brooksley Born is? Come on. All right. Well, she's a bothersome woman who used to work at the Commodity Futures Trading Commission, who wanted to see derivatives more tightly regulated. Alan Greenspan, Robert Rubin, Larry Summers shut her down because they thought it was critical that derivatives be lightly regulated. In the New York Times, they published really a fantastic piece of journalism about Brooksley Born, what happened to her, and why we had these over-the-counter derivatives with basically no regulation. The title of the article is, it's October 8th, 2008, The Reckoning, taking a hard look at the Greenspan legacy. Again, the New York Times. It's a long quote, I apologize, but to me, it's just delicious because it really shows the way that we've been sold downriver. Over the years, Mr. Greenspan helped enable an ambitious American experiment in letting free market forces run free. Now the nation is confronting the consequences. As the nation derivatives market took hold in the early 90s and in subsequent years, critics denounced an absence of rules forcing institutions to disclose their positions and set aside funds as a reserve against bad bets. Time and again, Mr. Greenspan, a revered figure affectionately nicknamed the Oracle, proclaimed that risk could be handled by the markets themselves. You know, he was a devotee of Ayn Rand. Proposals to bring even minimalist regulation were basically rebuffed by Greenspan and various people in the Treasury, and called Alan Blinder, former Federal Reserve Board member and an economist at Princeton. In 1992, Edward J. Markey, a Democrat from Massachusetts who led the House Subcommittee on Telecommunications Finance, asked what was then the General Accounting Office to study derivatives risks. 2 years later, the office released its report identifying significant gaps and weaknesses, quote unquote, in the regulatory oversight of derivatives. The sudden failure or abrupt withdrawal from trading of many of these large U.S. dealers could cause liquidity problems in the markets and could also pose risk to others, including the federally insured banks and the financial system as a whole. Charles Bowser, head of the accounting office, said when he testified before Markey's committee in '94, in some cases, innovation has and could result in a financial bailout paid for or guaranteed by taxpayers. 1994. Okay, in 1997, the Commodity Futures Trading Commission, a federal agency that regulates options and future trading, began exploring derivatives regulation. The commission was then led by a lawyer named Brooksley E. Born.